so let's dig a little bit more into what's going on with the car prices here, Jens. When we see the numbers coming down here, I guess how encouraged should we be by that aspect of it? Since you don't buy a car very often, for example.
Well, it's been a kind of there's a bunch of fluky things going on in the CPI report. We have some extremely volatile items that are driving the numbers every month. Like so, last month it was those used cars, and we've had some airfares that were driving it. So if we model what's going on with the used car prices, we can report from Manheim and so forth, and what should be feeding into the CPI report with a lag. I think we have more fall in prices ahead of us. I think this 0.5% decline in this report doesn't fully reflect what is actually happening. So that could be a further disinflationary force in coming months. So it's always a tricky bit. Like, do you try to forecast those volatile items, or do you look at the whole CPI basket? I think it's nice to look at the median of everything that's going on, right? And it's been extremely low for goods for now 3 months, and that will be further emphasized by some of these specific items. Yeah.
Well, for potential buyers too, and the customers out there, they're trying to figure out, all right, is this the timing for me to buy? Should I get in right now and purchase that new or used vehicle, knowing that the financing terms might not be as favorable as they were a couple years back?
It used to be the case that a lot of auto companies offered 0% financing for 5 years in the United States, right? So if you think about that, getting a car where you literally have 0 interest rates, and now it might be 8 or 9%. Like, this is a pretty big difference, right? So in the last couple of weeks, we had a kind of strange debate where interest rates were going up, and a lot of people are starting to say, oh, interest rates don't matter for the economy. I think that probably feels a little bit differently today. And certainly in the auto sector, the impact is pretty dramatic.
Let's talk about the broader consumer for a moment, because inflation is with inflation finally showing meaningful signs of cooling, it could be a welcome sign for the consumer, one would think. We have seen shoppers keep the U.S. economy afloat, although that's been more on the services side than the goods side. We know that you have been watching something called the Red Book Index of retail traffic and retail data. That's one of the many, many data points that you monitor, Jens. So what exactly is that showing you?
Yeah, I think I don't want to put a huge emphasis on one specific indicator, but I think what we are seeing right now is that there are a number of retail-related indicators that are kind of flashing red, right? So Redbook is one of them, but I think perhaps the more important one would be the consumer credit, right? So consumer credit was very strong last year. Some of the strongest numbers we've ever had. And the reason for that was that consumer balance sheets were very, very healthy because the government transfers in the COVID crisis were very big, so people didn't have to use their credit. But they used it aggressively last year, and now the numbers kind of show that either the credit card companies don't want to lend anymore, or people kind of feel, okay, maybe I shouldn't have such big balances, right? So there's something new going on there. I think that's very important, because if you look at what's happening in U.S. consumption overall, this cycle has been a crazy cycle. Like, the savings rate has gotten to levels that we've really never seen before, incredibly low savings rates. So it would be no surprise at all if the savings rate became normal. Much higher savings rate means less consumption, right? So when you look at the next year, that, I think, is really the biggest risk to the U.S. economy, that the savings rate just normalizes from a very, very low level. And I think these specific indicators start to smell like that is about to happen.
And so, even as kind of we compare this data against where the consumer is spending, or how they're spending, rather, I mean, we've been looking at where they're also pushing more towards using or swiping their credit cards or tapping to pay, whatever they're doing these days, versus deploying cash, as evidenced by the New York Fed's figures that they put out. So how do you kind of compare what we're seeing in a report like this from CPI and where you're tracking with the Redbook data? how the consumer is spending right now? Does it show or signal any signs of either distress or moderation?
Yeah, I'll repeat what I said before. Like this cycle has had so many different elements that we've never seen before. Like this huge shift between goods and services, initially towards goods and then back towards services. That's a huge thing. We still have a normalization of consumption patterns around people working from home now coming back into the office. You're walking around in streets in New York, like it really starts to feel much more normal, right? So there's a big shift going on. And when we look at numbers, we should never forget that the numbers are kind of like some aggregation of what's going on, right? If overall consumption is kind of okay because there's much more services consumption, people talk about Taylor Swift and so forth, and less traditional goods, it's still going to cause a lot of pain for the people who sell the traditional goods, right? So we might see that in the jobs figures for those sectors in coming months, right? You can't just average out. There's going to be pain in some sectors for sure.
It sounded like you tried to purchase tickets to the Paris tour then. That stopped for Taylor Swift.
Yeah, that made me wonder
no
too.
comment. All right,
Did you go see her?
No, but I would if I could get a ticket.
If you'd been able to sign in, huh? Something like that. All right, well, we hope that Ticketmaster fixed those issues. I think they did. Anyway, Jens, stay with us.